Thanks for joining Kevin, Alex, Harry, and I for today's educational video for the month of May. Today, we're going to be tackling a concept that quietly drives many of the investment decisions that we help clients think about when it comes to their portfolio management, which is investment time horizons. Oftentimes, clients will say, or prospects will say to us, I've had investments in funds before and it didn't turn out well. And oftentimes it wasn't because they held a bad investment, but that they held it over a short period of time and maybe it was the wrong investment for that time frame. So today the fellows are going to dig into what time horizons are appropriate for what different types of investments and how it might relate back to how your portfolio is constructed here.
Thanks, David. So what is it? Simply put, your investment time horizon is the length of time from today or the day you want to start your investment until the point that you need to access that money. That's it. It has nothing to do with your age or your risk tolerance. It's simply the runway between today and your goal.
And a lot of the time, people are going to have multiple time horizons for multiple different goals. For example, you might be saving to buy a car within the next year. You might be saving to fund your children's education in the next 7 years, while you also might be saving for your own retirement in 20 years from now. So it's not necessarily that you're picking a time horizon for your portfolio, but you're picking and choosing different goals and how to allocate that money towards those goals.
So let's walk through an example. This is the 3-ball strategy. Now, many of you will have seen this before. Harry's been using it for years, and it's a great visual for what we're trying to explain. Now, in this very first ball, this is your income ball. This is where we would put money that you may need in the next 0 to 3 years. In this ball, we would choose investments like high interest savings, money market funds, GICs, even some short-term bonds. For money that you may need in this very short time frame, we don't want to take any volatility risk with what's going on in the markets. If you need to buy a house in the next 3 months, we don't want to keep your money in a growth fund as the market could drop at any point 10, 15, 20%, and that investment would have failed you in that time frame.
Next, let's take a look at this balanced ball. Now, this ball is for more medium-term goals, let's say between 3 and 10 years. This ball is consisted of about 40% fixed income products and about 60% in equities or stocks. Now, the goal of this balanced ball is to limit your overall investment volatility as you're approaching your goal while still providing you with some time to grow.
And that brings us to the third ball, or your growth ball. This is where we put investments when your time horizon is longer than about 10 years. So this ball is purely designed for growth. These investments will usually be made up of 100% equities. There may be some fixed income in there as well, because we know you don't need this money for the next 10, 15, 20 years. So this is for long-term growth potential. And because our runway is so much longer, we can afford to ride out market volatility in the short term in order to achieve longer-term goals.
Now, here's how it gets interesting, because like we mentioned earlier, you might have different time horizons for different goals, and these balls aren't standalone. They work together to help you reach those goals. So, for example, let's say you have an income need. You would want to draw that money from your short-term income ball. Then, using funds from your balanced ball, you would top up that income into the fixed income section. And then from the equities ball, you would fill up the balanced to allow that to grow. What that does is it always ensures that you have the money available when you need it, while allowing the medium-term money to grow with a little less volatility, and the longer time horizon money to continue to grow throughout the longer time frame.
Now, this is especially powerful once you reach retirement. As Alex mentioned, you're taking your income annually out of that bottom income ball. But if, for example, we experience a market like we saw in 2022, where the market dropped quite significantly that year, we don't have to just replenish that income ball with investments that may be down in the short term in the balanced and growth balls. We can kind of freeze those two and continue to draw income out of that bottom ball because we've accounted for, like I said, up to 3 years of your income needs in that bottom ball. So if it takes some time for the market to recover, we can ride that out with taking those funds. And then once the market begins to recover, we can unfreeze the balanced and growth balls and replenish the income ball from those at that time.
Now, there are a lot of different investment accounts that you have the ability to open here in Canada, and a lot of these accounts can correspond with different time horizons and goals within them. So, for example, if you're starting to save for a short-term goal, I think that the best account for that to go into would be something like the tax-free savings account, where it gives you flexibility on your withdrawals, but also allows whatever interest or growth that you see in the account to be taken out again tax-free. Another good account for a shorter term goal, say if you're saving for a home in the next couple of years, would be the First Home Savings account that also lets you withdraw money tax-free for the purpose of a down payment.
Medium-term goals will often live inside an RSP or a TFSA, or when your children are very young, inside an RESP. Now, again, these time horizon runways are a bit longer, so we can afford to take a little bit more volatility risk with those investments. So as we said previously, it's not so much that we're matching investments to the account type. As I said, when your children are young, that RESP can afford to take some volatility risk. But as they get closer to graduating high school, we want to dial that back. So again, it's not the account type. The time horizon truly dictates how we choose to advise you in investing that portfolio.
So that's the key takeaway from this video. Rather than asking, what should I be invested in? The first question that you should be asking yourself is, well, how long is it going to be until I need this money again? Because that's how we're going to structure your portfolio so that the three balls work together to help you reach those goals.
And when we're experiencing market volatility, as we've experienced some extra volatility this year, it doesn't mean you have to wait to talk to us about investing, because if your time horizon's longer, the little bit of short-term volatility we're experiencing right now won't affect you 5, 10, 15 years from now. So if you have some money you want to invest and you want to talk to us about what's right for you and what time horizon may be right for you, give us a call. We help clients with this every day.